What's going on, everybody? James here, your investing kaki here. Today, we're going to dive right into the reasons behind the stock market crash and what it means for you as an investor. So, watch until the end of the video to explore 5 things you can do right now. With that, let's go. So, there are two main reasons, right, for the stock market plunge. The first reason is the US recession fears. Why? Because they have a weak US jobs report released on the last Friday, which showed that the unemployment rate has reached the highest since October 2021. Okay, and the report came the days after US Fed Reserve have decided to keep the interest rates at a 23-year high while signaling it will cut them in September. So basically, they have been waiting too long, okay, and now the market is fearful, right, that it is not taking action fast enough, like what Elon Musk has already did on Twitter, scolding the US government that they are not taking any action fast enough, and instead of a soft landing, it may lead to a crash or a looming recession. And the second big reason, right, is about this Japanese yen carry trade. So what is it about? I'm not gonna dive into the details of all this, how it came about and things like that. I'm just gonna give you a brief idea. So basically, a bunch of investors, all right, because yen is at a very cheap rate, so they borrow cheap yen to buy riskier assets in the US for potentially higher returns. But then, surprisingly, the Bank of Japan decided to strengthen the yen. So they decided to increase interest rates in Japan. So now that Japanese yen becomes stronger, those investors who borrow cheap yen are now scrambling to unwind their positions, which lead to a lot of margin calls and lead to a lot of market mayhem. All right. So all in all, because of all this, maybe they have to cover back the margin costs and things like that. So where does that leave us as an investor? So if you look at this website called currentmarketvaluation.com, the stock markets are also at a all-time high, or rather they are at kind of a lofty valuations. Hence, with all these trigger or catalysts like the yen carry trade plus the weak jobs report, it is resulting in the stock market sell down. Okay, so now let's take a look at what is the market, okay, valuation right now given the economic jitters. Right, so I'm gonna go through just a few valuation models. The first one is this famous Buffett indicator, all right, which they compare the US stock market value to the GDP itself. Unfortunately, okay, this is a free chart itself. We don't have the paid account, so I can only see the data as of 31st May 2024. And even back then, is already trading at 200% or 197% ratio of market value to GDP. So that is 59% higher than the long-term trend line. So you can see that the gray color, the historical trend line over here, that is what it should be. Okay, so right now, as of 31st May, it is already two standard deviations. That means it's overvalued lah in this chart per se. Okay, it's already two standard deviation higher. Right, if you take a look at another valuation model, for example, the PE ratio, okay, so this is easier to understand because we are all familiar with P ratio. And you can see also that as of 31st May, all right, it is already at around 1.7 times standard deviation above the historical trend. If you compare it back to the financial crisis, back then, the year 2000, right? Internet bubble was 3 standard deviations. So we are roughly in the middle. So I would say that we are not at the bubble stage, but still nonetheless pretty high as compared to when everything crashed during the financial crisis year 2009. It was -1 standard deviation. And the last valuation model that I want to share with you is interest rates. All right. So similarly, as of 31st May 2024, it is also 1 point something standard deviation higher. So all in all the valuation models, you can go and take a look yourself. There are also some recession models that you can read. You can read the chart, okay, decipher the charts, and also read what is the theory or the reasoning behind all these charts. And if you have enjoyed this video thus far, I will greatly appreciate it if you can help me to smash that like button, subscribe to my channel, and ring the bell so you get notified every time I release another stock analysis video. And now to the important part. What are 5 things you can do as an investor right now? Okay, so the number 1 is to don't panic sell. It's very tempting, but fire sales rarely end well. Instead, take a deep breath and reassess your portfolio first. It's very important, right? Because if you just sell every time there's a signal that or some guru saying that, oh, there's bad news and you need to sell, you wouldn't get back into the market, and you will be timing the market, and we all know that time in the market is what that counts. All right. So number 2, review your risk tolerance. Are you comfortable with some short-term volatility? And this is different for everybody, right? I may have a higher risk tolerance level as compared to some other retiree. Maybe they just want to retire, have a peace of mind. So you need to cater that kind of a risk appetite towards your investments as well. So consider rebalancing your portfolio if you cannot stomach this kind of high volatility when it comes to tech stocks or US stocks per se. Okay, so you can also have some cash on hand that provide flexibility and the opportunity when it comes to market sell downs like this, right? You can buy these quality stocks at lower prices. Okay, so number 3, which is similar to the previous point, right? You can buy the dip or you can dollar cost average, meaning you invest a fixed amount of money at regular intervals, okay, regardless of the price. So it helps you to average out your cost per share over time, and you don't need to keep thinking about the stock markets. Simply put, you can just put in $100, $200, you find some robo advisor, or you can just focus on one ETF like S&P 500 ETF, and then just pump in the money. You don't have to worry what the market is doing in the short term. All right. Number 4, focus on the fundamentals. So look for companies with strong balance sheets, consistent cash flow, and rock solid the business models. So these are more likely to withstand this kind of economic downturns, right? And I have left the last point for the end, right? Because if you take a look at this compilation of S&P index intra-year declines versus their calendar year returns from 1980 all the way to 2022. Okay, this is a research done by JP Morgan and FactSet. You can see that the S&P 500 index, despite averaging 14% intra-year drops, their annual returns were still positive in 32 out of the 42 years. Right? So you can see how some of the years, right, even though they have a drawdown of maybe 6% or 7%, they still end up with 20 something percent returns by the end of the year. Okay, so this tells us one thing: think long term. Okay, so remember, when you are feeling doubtful, when you are panicking, zoom out. Okay, if you look at the number of days or years, the stock market move, zigzag and things like that. But if you zoom out and look at it in terms of decades, you go to Google Finance and you click on the maximum time horizon, you can see that stock prices generally go up all the way in the long run. So remember, this is a marathon. When it comes to investing, this is a marathon, not a sprint. Stay disciplined and don't let this kind of market madness derail your investment goals. And if you need help navigating this mess or the stock market crash in general, hit that subscribe button, give me a like, and comment below what is your number 1 question right now, and I will get to them in another video. Don't also forget to subscribe to my newsletter as we get through these crazy market swings together. Thanks for watching, and I'll see you next time. Bye bye.